That was exactly my next question for you, which was just why did you want to take that big leap and head into Crawford Fund Management?
Right. Yeah. So as I was kind of starting to allude, the I realized, but only after I was in it, that the model of just being a research analyst, but not actually managing a sizable pool of capital in the sectors that I was following wasn't as gratifying to me. It didn't it didn't work for me the way managing the bigger pools of capital or a pool of capital. I the simple phrase that comes to mind is put your money where your mouth is, right? Easy to tell someone what to do, much harder to do it in your own pool of capital where the track record follows you and you're either making money or losing money for real people. So I wanted to get back to an environment where I was much closer to pulling the trigger, not just giving people advice. And actually, you didn't ask this question, but when I think about the arc of my career, I think that's part of the reason that I decided to move from consulting into investing is in the world of consulting. Consultants are often accused of taking someone's watch to tell them what time it is. And I think that a lot of the projects, I think I can even say of the projects I did in consulting were quality projects where I think we really added value for the clients. But at the end of the day, as a consultant, all you're really doing is making a recommendation, and whether the company chooses to follow it or not really in your power, right? I mean, you can be more persuasive or less persuasive, but at the end of the day, you can be incredibly persuasive and have just the right solution. And the company, for whatever variety of reasons, often political reasons or financial reasons, doesn't choose to implement your solution. And that can be very frustrating. So as I sort of think about my career and the parts of my career that I have been found most rewarding and fulfilling, it's where the hard work in making and coming up with good decisions and bad decisions gets quickly and efficiently translated into actual action. That is more satisfying for me. And so going to a place, I should say, where I was very close to the decision making was what I wanted to do. And I also will probably at some point in this conversation talk about culture, but working with people that I had a tremendous amount of respect for, had known for a long time, worked with before, was very appealing. So I made the decision to leave the mothership, as I call it, the big, huge, great organization of Fidelity, but to go to the exact opposite in the world of investing, to go from a 30,000 person firm, or 20 or 30,000 at the time, I think, to a 3-person firm. And you couldn't be more polar opposite, right, in the world of investing. But it was a giant leap, as you said, and one that I've always looked back on and said, I'm glad I did that. It has not always been easy. There have absolutely been days and weeks and months where I said, what was I thinking, right? In the sense that it is way, way, way harder to build an investment business than most people think it is, even people on the inside of the investment world. And my partners and I would all say that. We would all agree that building the business is not just about being a good investor and having a good track record. There are all these other business things, right? It's the operational, it's the marketing and sales, it's the client service. All those things are incredibly important. And now increasingly the regulatory world and being able to navigate that successfully is very, very important. And it makes being a small organization really challenging, right? To be honest, there are not a lot of 3-person organizations, as ours is still today, that survive 14 years as we have. Most either become much bigger quickly and succeed, or they failed. But it is extremely rare to find small investment firms that have stayed small and efficient and nimble and are still in business. So that's where we are today. I certainly don't mean to say it's all a bed of roses. It is still every day as a challenge. Every day is a new, whether it's investment or operational surprise, and sometimes they're good ones, and sometimes they're not. And, it is hard. I have an incredible appreciation that I never had while I was at Wellington and Fidelity for all the jobs that were being done other than investing in what we would call the back office of the investment organizations to make the organizations succeed, right? When you're in the investment arm of one of those big companies, you tend to think that you're sort of the stars and that, the organization wouldn't be there but for you, and, there couldn't be success. Well, I'm here to tell you that you can be a great investor and not be a financial success in this industry if you don't have the right operations, marketing, sales, tech, regulatory, legal. You have to have all those pieces at a certain level to even. It's the price of entry. You can't even get a client in this business if you can't check the boxes, on all those things, and then hopefully far more than check the boxes, actually have excellent service delivery in all those areas. It is not enough just to be a great investor. So it might be enough if all you're doing is running your own personal account, but it is not enough if you're trying to make a business out of investing. So tremendous gratitude and admiration for those functions in the organizations that I used to work in that I did not fully appreciate at the time.
See, I'm glad you brought up challenges, because I always like to ask, for especially obviously investors, how did you navigate, one, the Great Recession, and two, coronavirus? How did you adapt your investing styles in both of those?
Yeah. Luckily for us, and I think this is a reasonably unique answer in the world of investing. I guess there is no such thing as reasonably unique. It's either unique or it's not. But this is a reasonably uncommon answer in the world of investing. There are, I'm sure, other firms who could say the same thing, but it wasn't true for most. We actually didn't have to adapt our strategy. Our investment strategy, our business strategy may be separate, but just to focus on the investment strategy for a moment, navigating first the financial crisis, which happened back when my partners were running the same strategy at a much larger organization. They were running a sleeve of that organization, and they weathered the financial crisis extremely well. Being flat with this strategy in 2008 is really challenging, right? It's an fundamental equity long short strategy. So being flat in that strategy is really not something that a lot of folks were able to do. And then fast forward to COVID, and then more recently to the Great Recession, if that's what it's going to turn out to be. One of the neat things about our strategy is that we're a hedge fund, and we are truly hedged. A lot of hedge funds are not truly hedged. A lot of hedge funds are leveraged. So in other words, their investors give them $100 million and they go out and borrow 50 million and go and invest 150 million. And that's great when markets are going up and the stocks that they're picking are going up, because that leverage, amplifies returns. It is horrible when things turn, right? And markets go down and that leverage works against you, and you can very quickly, wipe out all the equity capital in the fund. So we don't do that. We hedge in the true sense of the original sense of a hedge fund, which is you have long ideas and you have short ideas. And that means typically, not always, but typically when markets are on fire, when they're big, strong momentum markets, your returns are not going to keep pace with them because you've got a short book that's dragging you down, right? It's there when you need it, but you don't need it during, generally speaking, you don't need it during big bull momentum markets, but you have to have it because it can flip on a dime, and you can't, most folks are not nimble enough to flip their portfolio around fast enough to go from a a long book to just a short book kind of thing. So you need it, in our opinion, you need it there, whether times are good or bad, so that you have the protection when you have the pullbacks that are inevitable. So we are always hedged. And the way we hedge is quite different than a typical fundamental equity long short firm, in that our hedging is not typically, we do some outright shorting, but mostly we buy put options, what we call single name equity put options. And you can think of those in simple terms as insurance policies on specific companies. You're basically buying insurance that says that if this company's stock goes way down, we can sell it at a higher price, right? It's an insurance policy on that company. And we have preferred that approach to outright shorting because the math of shorting is very asymmetric. And you can lose an unlimited amount, but you can only make a limited amount. And psychologically, shorting is harder too, because, in our opinion, because when a short starts to work against you, meaning you're short a stock, but the stock starts to go up, you have a very difficult decision to make. In theory, the short is more attractive because it's now higher priced. You think the stock's worth 50 and you shorted it, at 70, thinking it would go to 50, but now it goes to 100. Well, in theory, if you still think it's worth 50, it's a more attractive short. You should short even more of it. But the risk management piece of that is that it has now become a bigger part of your portfolio. It is more painful to you if you are wrong. And the market is telling you, hey, your likelihood of being wrong is higher than you thought it was. So you have a very challenging mental dilemma, which is, I think it's more attractive, but it's riskier, right? So what do I do? And that's a really big conundrum for a lot of short managers. And so Crawford has found, for us, it works better to buy insurance and not say, and instead say, we think this stock is going to go down. We're going to buy an insurance policy, an option on it, a put option, because we know we may be wrong, or we may get the timing wrong, but we're willing to spend a small amount in case we're right, knowing that the odds are that this is going to expire worthless, that we're going to be wrong, either because it never happened or we got the timing wrong, and it's probably going to expire worthless. But we put such a small amount into that insurance policy, and we bought a bunch of insurance policies on a bunch of different companies that we think are going to go down, that all we need is for a small portion of them to pay off, because when they pay off, they tend to pay off 5x, 10x, 30x when you're really right. And so when you get those 5 to 30x payoffs, it covers up a lot of mistakes with the ones that go to zero. And so what that means is when there are big market pullbacks like March of 2020 and the COVID crash, our strategy tends to light up. That insurance pays off all of a sudden big time, and it generates cash for you just at the time you want cash, because the rest of the market has just gone on sale. And you might want to start scooping up some of those bargains. But if you have a traditional short book, it's not generating cash for you. You already got the cash when you sold the short, right? So you already have that cash. It's not generating cash for you when the stock goes down. You have to cover it. You actually have to use cash to cover it. So there's only one way in the world of public equity investing that we're aware of that you can both have an insurance policy and you can generate cash at exactly the time you would like to have it. Now, I'm making this sound like the best thing since sliced bread, and you're probably going, why wouldn't everyone do this if this is so brilliant? Because very few people do this in the world of equity long short investing. There are several reasons for it. One is it's very hard. Most people's brains are either wired to be equity analysts, look for success, or they're wired to be options traders, thinking about Greeks, betas, deltas, thetas, gammas, which are all the Greeks that are used to describe the characteristics of options and how they decay over time, and the rate at which they decay, and the way that they are, how they correlate to their underlying stocks. So it's a whole different world that tends to be populated by PhD mathematicians, whereas the world of fundamental equity investing tends to be populated by people who do deep fundamental research, but don't really work in the world of options. So to find people who marry those two ways of thinking is rare. That's number one. Number two, there's no free lunch in the sense that you have to get the timing right of an option. And we could make the decision that, pick your stock, IBM is, trading at 100. We think it's worth 50. And we're going to buy an option 6 months out, $50 put, $50 strike price. Guess what? If that takes 8 months to play out and you bought a 6 months option, your options, you may have been right. You were early, but your idea was right, but your idea still was worthless because you didn't time the option correctly. So there are a lot of factors in addition to just thinking about, is the stock going to go up or down? You have to get the timing right. You have to get the strike price right. And you have to be able to think in sort of Greek terms, right? So it's just not as simple as telling most equity long short sellers to, sort of flip your short book to doing things in an options approach. But there's a third reason, and it's a much more cynical reason, but it's a real one. And that is that options trading is far less lucrative for Wall Street brokerages than short selling is. So if you're a hedge fund, your prime broker is never going to encourage you to do options. They're going to encourage you to do shorting. So you have to be a little bit of that contrarian thinker and be willing to sort of be laughed at or be told by your prime broker that, you're doing this the wrong way, or be told by your prime broker, we won't even cover, we don't even want your business if you're not going to do traditional shorting. So there are all sorts of reasons why you don't see most places doing this. And that's how we do it. So that is a super long, very detailed answer as to how we weathered two big incidents. But the way we weathered them was not changing our strategy at all. And that's why in March of 2020, we were up when most of our peers were down. And that's why, when the what I would call sort of the extreme momentum SPACs and IPOs and the super high flying tech stocks started to melt down a year and a half ago-ish, 2 years ago, we didn't change our strategy at all. We had always had big put portfolios on those names. We had been wrong and they'd been expiring worthless, but because we don't invest a lot in them, they weren't a big drag to our returns in the years when they were high flyers. And then as soon as they started to become not high flyers, and in fact, tremendous, laggards, our put book started to light up and profit handsomely, but we did not really change our strategy at all. So long answer to your question, but hopefully it gives you some insight into a different way of thinking about equity long short.
No, definitely. Do you use call options at all?
We do much, much less because typically, sorry, I think I talked over you there.
Like more often straight up by the stock.
Yeah. So our long ideas we tend to express with long equities. Our short ideas we tend to express with put options. We do buy some call options on long ideas. We buy them, we reserve call options for the sorts of longs that we would not be confident making sizable positions in the book because the risk reward is too high. But we do think that there is tremendous upside if some things that we think the market is underappreciating come to pass. And those we might use call options for. But it's a very, very, very small part of our book. Maybe 1% or less of the capital in the book would be in call options typically. And the reason is longs, the type of longs we tend to be attracted to, and we haven't even really talked about that, but the type of longs we tend to be attracted to are longs that have a longer duration. We tend to think in 3-year terms when we're going to make an investment in a company on the long side. And so because of that, you would have to buy an option with such a long duration that it would probably be uneconomic to do it. The shorter the option, the cheaper the option, right? The longer time period you're covering, all else equal, the more expensive the option because it's more optionality. So because our longs, we don't really have a strong thesis. Are they going to play out in 6 months or a year in 6 months or 2 years in 6 months? It would be very expensive to maintain a call book on those types of names. Typically, a few cases, as I alluded to a moment ago, are more appropriate for that, but not the majority of our long book.
Like what What are some books that you've read financially that
Yeah.
you would recommend the viewers to
You know,
read?
it's going to sound very trite. Um, the best reading in investing tend to be the old classics. So when I started at Wellington, I got a boxed set from the director of research of the original, sort of from the 1920s and 30s, the books that Warren Buffett always alludes to, that he read, right? And I should also point out, probably the best reading in investing are Buffett's annual letters. Go back and read years and years of them, right? Well, and by the way, I should say, as I said earlier, there are a lot of different ways to be successful in investing. Being deep, sort of contrarian, fundamental equity long short guys like we are, the gurus of that would be the Warren Buffetts, right? And his predecessors. But there are plenty of people who would tell you and would be able to point to very successful careers and would tell you to go out and buy books on charting and technical analysis. I've never read any of those. I probably should. It would probably make me a better investor. It's just not how I think. It's not the way I approach investing, but I'm sure there are great books out there on technical and charting and momentum, investing. And I don't necessarily need to put all those in the same bucket. But the Buffett and the Buffett, sort of way of thinking. John Neff, who, and I'm blanking on the name of Neff's book. It's sitting on my desk in my other office. But he wrote a book probably 20 years ago. John Neff was one of the big early partners at Wellington who ran one of the largest funds at Wellington, the Vanguard Windsor Fund. And Neff wrote a great book on fundamental investing. Peter Lynch's book, Random Walk, Down Wall Street. Yes, right. But yeah, Lynch's book on fundamental investing. Those are great Bibles of sort of looking for value and looking for cushions, right? Investing only in companies where there's cushions to what you believe to be fair value. Those are the types of sort of, Graham and Dodd analyses that I'm referring to that Buffett talks about. Then Graham, being sort of the father, if you will, of that type of deep fundamental, somewhat contrarian investing. So those are the books that I have tended to find most valuable, and Buffett's annual letters.
Okay.
So
Before I get to the last question, it's just crossed my mind. Have you ever been around an algorithmic trading system environment?
no. It depends what you mean by been around. Never worked in a firm that followed, algorithmic. I certainly know people who work in those companies. So you can't have worked in this business as long as I have and not occasionally meet those people or be at conferences where they're speaking. So I know enough to scratch the surface and be just a little bit dangerous in having a conversation about it. But please don't ask me anything deep because I really don't. It's not how I invest. I find it interesting. I think there are better mousetraps within that world that have proven, to be successful ways to make money over time. Not something I know enough about to have an intelligent conversation, though. So
The last question of the day is, what wisdom and knowledge do you want to leave to future generations?
yeah, interesting. So I would be proud, as I know my partners would be, if we could leave a legacy, even if a small one, of a better understanding of the ability to marry different types of investing, in our case, fundamental and options analysis. We think that there is tremendous value in doing that, and we think it's something that is greatly underappreciated in the market. For us, that's probably a good thing because it leaves an opportunity for us to do it and not, be inundated with tons of competitors doing it. But I do think that if the goal of being a good investor is to allocate capital more efficiently for the world over time, I would like to see more of the world think this way, because I think, and my partners think, that this is a better way to invest. So I would love to be able to leave that wisdom. In terms of a legacy, I I don't really think in terms of sort of leaving a legacy in sort of the financial world, other than I guess I would like to say firms should grow, right? Firms should grow over time. Healthy firms grow. One of my early bosses, one of the heads of the firms that I first worked in out of school, used to say that healthy firms grow, right? Because you do get pushback in organizations, and you get people saying, well, wait a minute, we're very successful. Growth is painful. Growth brings change. Why do we need to grow? And I think the answer to that is healthy firms grow. I can't give you the textbook reason for why that's true, but empirically, having worked in organizations that have grown and organizations that have not grown, I think it's healthier to be in organizations that grow, right? I think as people, our natural tendency is to want to grow, to expand, to spread our knowledge and our influence, our wealth, our capital. So I think healthy firms grow. In that vein, I would say that I hope that we can grow our current firm, Crawford, into a bigger organization that touches more people, whether it's through delivering strong investment results to more people than we do today, providing interesting and meaningful and lucrative work to more people than we do today, being good citizens of our community and our industry, so that we could have a greater financial and philanthropic impact on things that are important to us and to our chosen industry and communities. I think that would be the sort of legacy I would like to leave in a business sense. Of course, as a person, as a husband, as a father, I'd like to leave a legacy of happiness mostly, but also success for my kids, as my parents did for me, a real example of what's important in life. And that is, again, in my opinion, first happiness and being a good person, and then hopefully finding work that can lead you to financial success as well. But really, it's that self-fulfillment and happiness first. I think I'll stop with that, and yeah, I think that would be the sort of legacy I'd like to leave. I guess I will also say that despite the fact that I probably look ancient on this recording, I feel like a young man, and so I don't think a lot about legacy yet. That's probably for my next decade. So, yeah.
Well, Mr. Utzinger, thank you so much.
You're welcome, Enrico.